Everybody, my name is Felipe Serrano. I'm honored to give a brief intro about myself. Strengthening Out Financial, which I started earlier this year, and a little bit on Index Universal Life. So quickly about me, I spent 23 years of my life in public service, 7 years as a soldier, 16 years as a federal employee. I have 3 adult kids, you can see here, Iana, Andre, and Angelique. I have 3 stepkids, Genesis, Phoenix, and Orion. And then that's my granddaughter, Kiana. That's my mutt, Goku. He's just a goofball. And then that's me and my girlfriend, Sherry. Back in February 2025, I was offered a buyout from the federal government. After some back and forth and some deliberation, I went ahead and decided to take the buyout. I always had a passion for financial services, finance in general. My degrees are in finance. My leisurely reading was for a long time, 100% just reading about finance books, whether it be stocks, options, or what have you. So I decided I wanted to go ahead and get in that field and do more meaningful work helping families as opposed to finishing out my time with the federal government. While I was searching for that time, searching for a financial services position, a business opportunity came my way that led to the formation of Strengthening Out Financial, and that which also led me to discovering about Index Universal Life products. So prior to this, I was not aware of them. I didn't know they existed. So in short, Index Universal Life products are permanent life insurance. You get a tax-free death benefit. You get living benefits if you're critically ill or terminally ill or what have you. There's the cash value component that's tax deferred. You can access it tax free if you do policy loans. So then with your cash value, the interest is tied to an index. That's hence the Index Universal Life. And the insurance company guarantees you a floor so that if the markets crash, you keep all your money. And then in some instances, there's a cap. So if the markets go very high, your rates are capped. But as I'll show you in a little bit, not all the indexes are like that. So there are plenty of indexes without any caps at all. We're going to go into 2 examples. So this is just scratching the surface of what Index Universal Life can do. I'm doing 2 examples of people using it, life insurance for retirement planning. In the first example, the client is married, he has a mortgage, has car loans, has debt. We'll show you how this setup is a little different than in the second example where the person's single and is only worried about cash accumulation. So for this particular plan, we're using F&G, a Pat Setter, Index Universal Life. Their initial death benefit is $800,000. If God forbid the person dies in the first week, the insurance company has to pay out that $800,000 once the policy is enforced. We chose 4 indexing strategies, and as I kind of briefly touched on prior to this, the S&P 500 is the only one that's capped. Morgan Stanley, BlackRock, and Barclays are not capped. Tax-deferred growth. Again, if you use policy loans, you don't just take your cash out. If you do a policy loan, you have access to it tax-free. And then accelerated living benefits, I should say, if you meet one of these conditions, where it's critical illness, terminal illness, or chronic illness. So for this particular plan, the person setting up $625 per month, starting at age 34 until age 65. The estimated earnings is 6.4%. He would have $558,000 in cash value. He could start withdrawing $42,000, almost $43,000 a year, and he'd have a death benefit of almost $1.3 million. All of this at age 66. Now, again, because this isn't max funded, it's not going to give you the highest cash value, but as you can see, you still get a significant amount of cash value. And also in this plan, because it has a larger death benefit, there's room to grow in it. So in the example that I did, he only put $625 per month all the way up until age 65. He actually has room to put into his account up to $2,800 and change every month. So obviously, as he pays off debt, as he pays off his car, as he pays off his mortgage, they could funnel more money towards this IUL, and the cash value would grow as with the death benefit accordingly with it. And then, and the second one, we're dealing with somebody that's single. He heard about IUL and about the cash value side of it, about the tax-free, tax-deferred growth. So we did a tax-funded well for this particular person. So the immediate death benefit is only 150,000 as opposed to 800,000. We use the same strategies, indexing strategies. Once again, S&P is the only one that's capped. Tax-deferred growth, everything else is the same. The IUL is the same for both of them. But the biggest difference is that this has the minimum death benefit that I could provide them, whereas the other one was more tailored to what the client needed with the 800,000. So next I want to show you the illustrations for these. So second one, set them up with putting in $545 per month. Same estimated earnings of 6.4%. By age 66, he had 680,000. So around $1,000 more than, because of that, the costs are less. So the cash accumulation is greater. The other thing to note though is that this is max funded. So 545 is the max that he could put in the account a month. If he tries to put more, the insurance company has to send it back. Otherwise, the insurance policy turns into a modified endowment contract, and then you lose the tax-free benefits. It's no longer an insurance policy. Now it's an investment. So there's a give and take with having max funded. So max funded is the most efficient form for cash value. However, like the name says, it's max funded. So if you have more money, let's say you have $1,000 a month to put in, you'd have to set up another account. You couldn't add it to this account. Whereas with the first policy that we showed with the $800,000 death benefit, there was room to grow. You could put up to $2,800 and change into that account. So like with this illustration, this is for the $800,000 face value, put $7,500 a year. By age 66, these are the totals. Then by age 83, I picked that because I'll be happy if I make it to 83. He would have paid $240,000 and would have withdrawn $770,000 by age 83 and still had $321,000 in death benefits. And all that $770,000 is tax-free that he withdrew it. Also want to show just real quickly the guideline level premium. If you divide that by 12, that's the most that he could put in a month. The guideline level premium is the most that he could put in a year. So he's actually putting in a little more than the target, 7,500, but he could put in up to almost 35,000 a year. So that's the give and take with a max funded versus a non-max funded. One has the higher death benefit. One has room to grow. One is you're getting the lowest death benefit, but it's the lowest cost and the max cash value. Here's the max funded one. So again, 150,000 is a death benefit. 545 monthly is what he's putting in. By age 66, these are the totals. By age 83, he would have paid in 209,000 and would have withdrawn 1 million and change, and still had 438,000 in death benefit. So I don't like saying one's better than the other. If all you're thinking about is cash accumulation, then max funded is the way to go. If you're thinking of family legacy, if you're thinking of taking care of your spouse and your kids in case something happens to you, then you might want to consider other options. There's my contact information. If you want to reach out to me directly, you have any questions or what have you, I'll be posting this on social media, so you can reach out to me on social media as well. Thank you for your time, and I hope to be producing more content in the future. Thank you.